Well, a day after the Commonwealth's effort, Qantas reported another fall in profits, down about 4% to $117 million, and again failed to pay a dividend, yet investors were reasonably happy. I spoke to Qantas chief Alan Joyce about the outlook and whether there are at last some blue skies ahead. Alan Joyce, it looks a bit like the improvement in profit is mainly down to cost cutting. Is that right, or has there also been a pickup in air travel?
Yeah, what we've seen, Alan, is actually a good cost performance for Qantas this year, with our Q Futures programme delivering more than the $500 million that we outlined to the market at the start of the year. It achieved actually a $533 million improvement. But most pleasingly, we are seeing an improvement in the yields. The first half of the year was impacted quite severely by the GFC. In the second half of the year, as the business markets start travelling again and the premium markets come back, we've seen the Qantas Airlines yields improve. And for example, in the last quarter, Qantas international yields were up 12% on the prior year. So there's a combination, I think, of good news stories in this results, good cost containment, good cost management, but at the same time now an uplift in revenue as a result of us coming out of the GFC.
When we spoke this time last year, you told us that the London and LA routes were losing money, and that was causing, in fact, the whole Qantas airline to lose money. Now, I noticed that you've cut capacity in international by 10%, but are the London and LA routes still losing money?
That's right, Alan, and you're absolutely right. We did talk about the international business being more impacted by the global financial crisis than any other part of our business. And because the UK and the US are a huge proportion of that business, and those two economies were also more dramatically affected by the GFC, we did see those routes go into losses. If it wasn't for the volcanic disruptions that cost us $46 million in the last quarter of the year, the UK route would have gone back into profits. And it's pleasing that we're seeing an improvement in the US route, with our Australian to LA services getting close to break even again. That's a big improvement on where it was previously. But overall, the international routes are still bringing down the Qantas numbers. Domestically, we're seeing a big improvement on Qantas. International is depressing the numbers still a bit.
Are you going to leave the international capacity where it is? Any signs of increasing capacity there?
We are planning to stay at that minimum network now. We don't plan to take any more capacity out. And when we see the market returning, which it is starting to return, as I said, in the last quarter we started seeing positive signs there, we will look at growing international markets. As we have in domestic. For example, this year in the Qantas domestic business, we're going to grow it by up to 8% because the premium market has returned and the returns have returned to our Qantas domestic operation.
And is business travel picking up generally?
It is coming back generally. There's been a patchiness. The Australian market is very strong, and the business and premium market here is coming back pretty fast. We're seeing patchy results around our international network, but there are very strong returns of business traffic in the Asian markets as well. The UK and the US are lagging behind the other markets, as you'd expect, with the lagging recovery of those economies.
Airlines have an unfortunate habit of flooding the market with capacity every time there's any sign of an upturn. Do you have any concerns that this will happen this time?
Well, I have to say, during the global financial crisis, we had a huge amount of capacity being added to the Australian market from a lot of our competitors anyway, Alan. There wasn't any difference. I mean, the international capacity growth into Australia was double digit. So I don't expect any change. We've been coping with huge additions of capacity into this market. What's very important for us, though, is that we've maintained our corporate market share on the key markets internationally. And for us, it's all about that corporate market returning and starting to fly again. That's where we get the best leverage. So we think that, in particularly on the UK, that market's starting to come back. It'll probably be a bit slow with the UK recovery, but we're very optimistic about the international markets coming back into profits.
Jetstar's also growing very quickly. It's now up to 350 flights a day. On 98 routes, which is about 5 times the volume that it was 5 years ago. At what point does Jetstar start to cannibalise Qantas, the main airline?
Well, I think they're absolutely complementary, and there's no discussion in favouring one over the other, because we believe that both can grow. You know, I remember in the midst of the GFC, people were saying that the premium market's dead, it will never return. We committed ourselves to investment in the premium market and committed ourselves to $100 million last year in developing Qantas's product in infrastructure because we knew the premium market would come back. At the heights of the fuel crisis, people believed the low-cost model was dead when fuel reached $145 a barrel because low-cost carriers had difficulty coping with it. And now look at the returns the low-cost carriers are generating.
Do you think the move towards discount airlines everywhere will result in a widening of the differential between the front and the back of the plane within Qantas, so that the back of the plane becomes more like a discount airline, as it were?
No, actually, I think the opposite, Alan. I'm very keen to continue to invest in making sure that the back of the plane on a Qantas brand is highly differentiated from the low-cost carriers. People are willing to pay a premium for Qantas. They're willing to pay a premium for the service and the in-flight product, the entertainment, the meals that are all encompassed in the airfares. We see that every day. For example, you look at Melbourne, Sydney. Qantas actually carries more leisure passengers, economy passengers, than any other carrier. Yet it's a route that has Tiger, Virgin and Jetstar. People are willing to pay more for Qantas because of the brand and because of the product. And there is a market for that, and it's clearly there on one of the biggest markets in the world. And I think Qantas will continue to enhance that product to make sure people are willing to pay that difference.
And is Tiger still having an impact on the market? Are they still driving prices down?
Certainly on the leisure market, the competition has in the last quarter become more intense with the amount of capacity that's been added. But Jetstar is holding its own. We believe that Jetstar is more profitable. It's the second most profitable after Qantas carrier operating in the domestic market. And it's still very small compared to the Jetstar operation. Jetstar is an operation now it's going to grow to $2.8 billion, and it's growing at over 20% each year. So we're very comfortable with Jetstar's economic performance, its market position, its growth prospects, and we think everybody else is playing catch up.
Thanks for joining us, Alan Joyce.
Thanks, Alan. It's great to talk to you again.